Thank you for joining me for a short look on what we as investors should be worried about right now. And I'm going to remind you that if you have not subscribed to our channel, now is a good time to do so. And you can also do so at any time during the video. To look at what we should worry about, I want to start with Paul Singer's assessment of the market. And Paul Singer is one of those hedge fund managers that many investors just don't know about. He has been in the business a long time, since 1977. His fund has been profitable every year except for 2 times since 1977. So he's very consistent. He's beaten the S&P 500, and he made money every single month in 2020. This was the year when we had a big pullback and a big rally. Frequently, what we find with investment managers is if they catch the pullback, they miss the rally. Singer didn't do that. Now, his performance is one reason that he should be in the news. Another is just his methodology. Singer is the hedge fund manager who bought some distressed bonds in Argentina. When Argentina tried not to pay, he took them to court and briefly seized one of their naval ships. This is an aggressive manager who really knows his stuff. His team digs into the documents defining bond investments, and he finds a way to collect. He's been very aggressive against Argentina. He also was involved in Peru's change of command a few years ago when a president fled the country only after Singer extracted his payment that he was due, and he was involved in incidents that led up to the impeachment of the South Korean president. So this is a manager who really is looking all over the world, knows quite a bit about the investment scene, and he's warning us trouble ahead. And he sees a rare combination, a confluence of factors that tell him we have a crisis pending. And he looked at these factors as early as 2006 and started piecing together what would unfold in 2008. He has a long record of success. Let's look at each of these worries in turn. Low-quality securities are leading the market. And to illustrate this, I'm looking at a chart of Goldman Sachs index that takes non-profitable tech companies. So at the time the index was formed, it included Uber, Zillow, electric vehicle battery makers, just a collection of tech stocks that don't make profits. And since the market bottomed in March of 2020, this index has led the stock indexes higher, and that's a concern. It could be pricing in just the fact that these companies are going to turn profits this year and are going to be incredibly profitable in the future, but that's unlikely. We know that it takes time for many of these startups to generate profits, and we know many of them never will. This is similar to what we saw in 2000 when stocks traded at incredible premiums that priced in strong profits. When the profits didn't come, it took years for the tech stocks to recover. Low-quality securities leading the way higher, that's generally a sign of a market top, especially when valuation metrics are staggering, and that's what we see right here. This is Shiller's CAPE ratio. We are at a level seen just once before in 2000. We can justify that by saying interest rates are low, but that's ignoring the fact that interest rates were low in the past and valuations did not reach this type of level before. That low interest rate structure has led companies to become over-leveraged. And what Singer means by this is companies are borrowing an awful lot of money. With low interest rates, sure, that's justified. However, they are at historic extremes. They were at historic extremes before the pandemic. During the pandemic, when easy money became the name of the game, companies just picked up the cash. Now, this is a concern because a lot of corporate debt is variable rate. So when interest rates rise, debt service costs will rise. That will reduce investment opportunities, and that will lead to a slowing economy. Another factor, as debt service costs rise, companies may try to make it up on volume. Some of the weaker companies may cut prices, leading to price wars that will eventually lead to them being out of business and prolonging the depth of the recession. So over-leveraged capital structure, a huge concern for the long term, because giving money to weak companies is generally not a good idea. The bankruptcies that follow will have ripple effects that last for some time. Singer also notes there's a scarcity of honest profits. To illustrate this, I went to the Standard & Poor's database and looked at operating earnings, how much the companies in the S&P 500 made from making stuff and providing services, and calculated the percentage of operating earnings as a percentage of reported earnings. Reported earnings include operating earnings, money they make building stuff, along with accounting earnings, depreciation, and other assumptions that the accounting department provides to increase earnings. Operating earnings has fallen steeply over the past year, and that's a concern. Companies aren't really generating earnings that justify the high valuations based on operations. Enron is a great example of a company that did more with accounting departments than operating departments. So this is why the scarcity of honest profits is a concern. We just aren't seeing companies make money in the real economy. They're making it in the accounting departments. Singer is concerned the most active traders reveal a desperate dearth of understanding. I'm not going to elaborate this point. We all know what he means. Reddit and Robinhood have changed the market for now. This is most likely a short-term change, just as it was in 2000 when day traders rushed in, just as it was in 1929 when day traders rushed in. If you read about 1929, you'll read about actresses who quit acting to manage money with the technology of the day, which included telephone lines to their apartments and the ticker tape. In 2000, the internet enabled that and replaced the ticker tape and the telephone. Now, social media is replacing that. We've seen this before when the most active traders reveal a desperate dearth of understanding. It tends to end after a brief time. Economic macro prospects are not thrilling. This can be seen in personal income. The blue line shows personal income jumping, 10% increase in the most recent data. However, all of that increase came from government transfers, stimulus payments, and the government borrowed that money. The government is over-leveraged itself with debt to GDP exceeding 100%, the borrowing binge continuing, the real economy lagging, and supported only by an unsustainable level of transfer payments from the government. So the economic macro prospects, just not as thrilling as a lot of people believe. Singer's concern is that the future holds return-free risk, and that's going to be an important phrase to remember. Remember, as investors, we want low-risk returns, and Singer is saying it's all risk right now. That flamboyant lineup of excesses possibly going to haunt investors. We need to be wary when one of the greatest investment managers of all time is wary. Just a reminder, if you haven't subscribed to our channel, please do so and watch for our next updates on the market action.